The 6 math formulas behind winning in trading. Every single trader should know these 6 math formulas as they build up the backbone of what trading is built upon. They've also been crucial for me building my own automated portfolio of trading strategies. Now, the first one I think many of you may have already heard of, and that is expected value. Now, this truly is the backbone of what trading is built upon, and positive EV is what you're after if you want to succeed in trading. Now, you'll want to calculate this for every strategy or for almost every trading decision to some extent. You always want it to be positive EV, but what exactly is EV? Well, in the complicated formula fashion, this is how EV looks, and X is a random variable, and PX is the probability of that random variable. But let me break that down into something that's a bit of a simpler fashion. So let's look at the lottery. This is a really easy example. Now, obviously, there's some caveats here that don't apply directly to trading, but hopefully this should give you a general example. Now, the Mega Millions multi-state lottery has the odds of approximately 1 in 175 million, and in the actual percentage form, that is 0.00000056. You get the point. But the total winning, now if you were that very small percentage, you would win a grand total of $43 million, which is actually kind of crazy. But when you actually calculate that out as what is the actual EV, so the expected value of every individual lottery ticket, well, that comes out to about 24 cents per lottery ticket. Now keep in mind, each ticket is $3. So every $3, you're basically lighting on fire about $2.80, give or take. And that's how we know if you bought a ton of lottery tickets, you're not going to have a positive outcome if you play it over the long run. Now, obviously, you could get incredibly lucky, and as some people do, they win 43 million. But when we're looking at it at a statistical point of view, which trading obviously is, we are knowing that this isn't really a positive expected value. You're not getting paid to take that trade, let's say. Now, this is how you'll want to look at a lot of your trading and every individual strategy. You want to see if this particular thing that you're doing and that you're risking money on has a positive expected value over the long run. Now, that doesn't mean over the next 1 or 2 trades. It means over hundreds, thousands, etc. Now, the second one is a risk of ruin. So this is going kind of to the complete opposite side of things. Expected value is about, us making money, having a positive expected value in the future, whereas risk of ruin is protecting our downside. This calculates the probability of us losing your entire trading capital. It's the cold hard maths behind why proper position sizing is absolutely key in trading. And ultimately, survival is everything in trading. If you run out of capital and you can never get new capital again, trading's done for you. You need capital to play this game, and you need a sizable amount to actually see solid returns. Unless you're getting very lucky, almost like winning the lottery and getting, 1,000% on a single trade just because it was quite a lucky trade. Now, to give you the basics of this, because risk of ruin can be quite a complicated formula to do, I will show you an example formula that's actually from a book. But to give you a very general example, if you lose 50% of your assets, a portfolio, let's say, you'll need to make 100% to make that back. And if you lose 80%, you'll need to make about 400% back to actually make back that 80% that you lost. This really shows why not having substantial losses is kind of key in trading, because you're going to have to make solid returns to get even close to break even on that. So ultimately, we want to protect that downside as much as possible. And that's why you'll see whole funds where the returns aren't amazing, but the downside control is impeccable. And that's why they are so valuable and why people put a lot of money in them. Now, for the actual risk of ruin calculation, here is an example one if you'd like to use this. There are some other simpler versions online, but this is actually from a book, Portfolio Management Formulas. It's a very old book. I think it's from the 1990s, but it has some decent formulas that have become kind of standard practice now, and risk of ruin was one of them. Now, the next one is the Sharpe ratio. Now, the Sharpe ratio is the gold standard for measuring risk-adjusted returns. It primarily answers the question, when you boil it down to, is how much return am I getting for the volatility I'm enduring? I like this saying, or particularly on my channel, that you really don't get any gain without any pain. You're going to have to take on some excess pain to get that excess gain over a risk-free rate. And Sharpe ratio is kind of demonstrating that of how much volatility are you actually suffering for that return that you are getting. It also provides an amazing way to compare strategies. This is the general formula for the Sharpe ratio, quite simple overall, and most platforms will already have a Sharpe ratio calculated for you, so it would be very rare that you'd have to manually calculate this. Now, there are alternatives. There are the Sortino ratio. There are many other performance metrics you want to look at as well when looking over a backtest or live performance of a particular strategy. But the Sharpe ratio has become the golden standard and is what is mostly used in most cases. There is also an argument that Sharpe ratio is better than the Sortino ratio, even though that the Sortino ratio only takes into account downside risk. If you're not too sure what that means, let's say we had an equity curve. Let me actually just move this a bit over here. Let's say we had an equity curve. This was baseline, and we were growing, and then we had a really sharp downturn on this equity curve, and then we went up again. The Sharpe ratio would take into account all this volatility, so this downward move and this upward move volatility, between these upward moves. Whereas the Sortino ratio only takes into account the downside volatility. This is kind of simplified, but hopefully that kind of admits that point. The reason it does this is because realistically, investors only really care about what downside risk they're having and the volatility in that case, not really the upside. But that isn't always the truth. So there is an argument to be made there that the Sharpe ratio could be better in different elements. But that is a bit too complex for this particular video. Let's get into the next key math formula, which is the R multiple. R multiple is a really simple concept. It's been made famous by a couple of different people. The most common one on YouTube, at least, is Brian Lee, but he wasn't the founder of the R multiple, but he really did popularize it quite a lot in at least the day trading space. It's a very simple but powerful way to standardize your trading results. Instead of thinking in dollar terms and trying to disassociate your trading P&L in dollars, you think in terms of risk. So a 2R trade means you made twice your initial risk, and minus 0.5 means you lost half of your initial risk. It's basically a really good way to detach from your trading profits, because when you see it in dollar terms, your brain instantly calculates, oh, wow, I could have bought X thing, or I could have paid X rent with that amount of money. Whereas when you're seeing an R, it removes that element from it. And it can mean that you have a better way of actually viewing your trading performance. And maybe it's even easier to see if that was on your trading P&L for the day, where you just see plus 2R instead of, plus $2,000, for example. Now, the next one is a bit of a long one, but it's CAGR. So this is the compounded annual growth rate. Now, this is really the true measure of your performance over time. It allows you to compare strategies across different time periods and set realistic growth expectations. Now, why do I say that? Well, as kind of insinuated with the name, it's just the annual growth rate, but it's also the compounded annual growth rate. So let's say we had a strategy, just as a very simple example, let's say we had a strategy that made 50%, but this was over, let's say, 5 years. Let's put 5 years up here. So it made one strategy made 50%, and the second strategy made 55%. But what we don't see here is that this 50% strategy made it pretty much all in 1 year, and the rest of the years it was pretty much flat. Whereas this particular strategy, let's say, averaged about 10% each year, give or take, or about 11%, and that made up its total performance. And that is what we can see with the CAGR. We aren't able to see what is the average compounded growth rate per year, as that's what's most important. Because a strategy doing 200% sounds great, but if it's over 10 years and the CAGR is actually less than what the SPY did, so what normally most people are benchmarking to, it's not a very good strategy. And this is just one way where we get to compare and actually make solid assumptions and comparisons between the strategies. And this also helps us set realistic growth expectations. If you see a strategy did 300% over 3 years, that sounds great. You're thinking, hey, I'm going to make 300%. Well, let's actually see what the CAGR was over that each year, etc. And that gives you a more realistic outcome over the next year that you'll be trading it. This is how you calculate the CAGR. Most platforms will already do this for you, but if you want to use the formula, then here it is as well. Next is the probability of winning and losing streaks. Now, this is personally actually one of my favorite topics because I think it's really overlooked. Now, this calculates how likely you are to experience consecutive wins or losses. This also relates to basically what a drawdown is. Not always the case, because drawdowns don't always have to be consecutively, but primarily this is what a lot of drawdowns come down to. Now, even with a 70% win rate, you will eventually hit 5 to 6 consecutive losses. Now, if you didn't know about this formula, if you've never backtested your strategy, you might be thinking, hey, I just had 6 losses in a row. Now, if that's especially not an intraday trading strategy, it's a swing strategy, you've taken 6 positions, each one of them has lost, you might get worried about your particular strategy. Is it no longer working? Does it even work in this particular market environment? You might even start tweaking it and actually changing the whole strategy. But if you'd actually backtested and known what is the amount of consecutive losses you could encounter, or even if you just know the win rate, then that will give you a better idea of what you can expect. So here is a full table kind of mapping them out. We can see the win rate over here, and we can see the probability of having consecutive losses. So we can see here at 50%, you have about, let me just draw a line, 95% chance that you'll hit 5 losses in a row, and then you'll have a 78 for 6, and then etc. You can keep on moving down. Understanding this primarily prepares you mentally for the inevitable losing streaks. Now, this sounds like a really simple point, but believe me, when you're actually trading real capital and you're feeling it, this is incredibly crucial that you're able to set realistic expectations. And then next is the damage of those expectations. If you didn't have these expectations in place, you could abandon a good strategy just during normal drawdowns. You could completely change it and tweak it and then ultimately damage the edge of that original strategy. But when you have these expectations and you also have done a proper good backtest, then these can save you from those outcomes. And yeah, I hope these help, and I'll see you in another video.